go up. And by that, I mean the moves in the dollar, right? The 2 straight big days in the dollar last week, and yet gold and silver were still up. Pull back today, gold and silver go up. So that's probably one of the stranger things.
It's a huge deal. I've been watching it as well, and you're absolutely right. We can go to the chart here, and we can see, I mean, the rise in gold has been absolutely relentless, and silver has been even more so. I mean, I got off the boat for gold last week. Thankfully, I stayed in silver. I did not have on my bingo card that whatever this was going to be another massive push to record highs. Here's silver. Thankfully, I'm still in this one. It just will not give it up.
Wait a minute. So there's things that you actually get long? I thought you just got short everything.
Absolutely. I'm long all kinds of things. I'm long the dollar. I'm long Brazilian stocks. I'm long metals. I'm long bonds. All kinds of things.
I just thought you were short everything, and you're like, everything's going to hell. Like, what's the point of it?
I mean, it is, but I'm not going to stand in front of price action that's moving. If you're right at the wrong time, you're wrong.
Right.
And so,
don't you think, though, Ilya, that this more than anything is a perpetuation of really a return to sort of the overriding universe of optimism more than it is anything else? That it's sort of like the Fed meeting is behind us. Whatever sort of things, it's more wall of worry-ish, and we're back on.
I mean, it could
some derivative of the supernova.
Here's what, and I think Jamal's point here is very well taken. This is a bit weird for gold and silver, because you wouldn't expect for the dollar to be going up and for them to be surging like this. Typically, one is a foil for the other. And yet, here we are. The dollar has been rebounding. It's down a little bit today. It was a little bit soggy on Friday, but the overall direction here through this period that gold and silver have been going up is for the dollar to head higher. We can see that in the dollar index here. The other thing, and just keep in your head here, that this is September 17th, this low in the dollar. Take a look at what's going on in the bonds. Here is that same September 17th. That, of course, is the Fed meeting. So since the Fed meeting, the dollar is up, yields are up. Gold doesn't yield anything, silver doesn't yield anything. They typically get walloped in an environment where gold is facing both a dollar that's rising and yields that are rising, because both of those things are kryptonite for a metal that is, and for precious in general, because they're basically alternatives to fiat. If fiat is rising, you don't need alternatives, and alternatives to yield, because they don't pay any yield. And so you look at this and you go, well, what do these things have that is taking them higher despite what should be a terrible environment? And it's tempting to say that it's sort of a rising tide lifts all boats kind of a thing, but you're not seeing it elsewhere. So here's, again, the Fed. Where have we gone? Basically nowhere. Here's the 17th right here. We're kind of still stuck.
Yeah.
And it's the same thing for Nasdaq. It's the same thing across the board. I mean, disregard this sea of lines here. I
actually kind of like that. I think that's good for healthy markets, honestly, if you get a couple of days of pullback and sideways action.
Yeah. No, there's nothing about these stocks that says that they're going to collapse. But I don't think anything about this explains what these metals are doing, if not what is sort of you can't prove this, so it might as well be this explanation, which is that we might have a government shutdown. We might have a Supreme Court that overrules the bulk of the president's tariffs at a time when the markets just spent 4 or 5 months digesting them finally. So maybe it's just uncertainty. Maybe it's just hedging.
You're saying maybe it's just uncertainty hedging that's driving the bond and metals?
That's driving metals in particular, and I would think the bond.
I mean, I guess that's why. But how do you reconcile that with the resume and the incline of the Nasdaq?
I guess I don't see what the Nasdaq is doing today as resumption so much as it is continued kind of digestion in this range. I think if you look at what's going on here on a shorter term time frame, you can see, and maybe in 8 hours a little bit more sane, what have we done here? We had a sell-off in the wake of the Fed, ultimately, on some digestion. We've come back, and we're basically retesting the underside of where the break occurred. And we tried higher today. We tried to make a run for the highs. We couldn't stick it. So we're kind of mid-range-ish here. If this is your kind of rough top and this is the bottom, we're kind of in the middle of a range, attempting to find whether whatever this was is just a pullback, yet another in a move higher, or there's really something here that's more substantive.
Well, I mean, I
wouldn't say that there's vigor in the stock market today.
Yeah, and some people
I'd rather be long than short.
I agree there.
I mean, some people would say that lack of vigor is probably due to the impending government shutdown. Now, this is the point where I have to ask, and I mean this sincerely. Dylan, how often do you hear about U.S. stocks, for example, and over in Milan? I'm curious. Is it like a regular, point that this is going on, the Dow, Nasdaq, S&P, or?
No.
So, okay. Well, and is there any mention at all of a potential government shutdown in the United States?
No, there's almost no discussion of the U.S. government. Hasn't been for months. As much as possible, it's a topic that's avoided.
And that's why I find it
Ever
so funny.
since April.
That's why I find it so funny.
The man came out with the phone board, and now nobody wants to hear anything.
That's why
Ever
I find
since
it.
April, it's a topic that's best left undiscussed, Jamal.
And that's why I find it so funny that there's all these different people that are trying to make this such a huge catalyst that the impending government shutdown is going to falter stocks, or we're trading sideways because of that. I don't believe it.
Yeah, but I feel like the
really
government shutdown lives in the same world as like hurricane coverage, where it's a bonanza for the news industry, because it's like it creates a deadline and a countdown and villains and heroes. It's great content, but I don't actually know how relevant it is to the economy, other than it's like the billionth display of incompetence from the U.S. government. But that's not a new piece of information.
Yeah.
This is where it gets interesting, right? Like the actual shutdown probably isn't that big of a deal on the face of it, because to see any sort of economic impact from that would take months to actually have it visibly show up in some kind of data. And in the meantime, it's all, well, how credible of an economic hit do you think it's going to be? And that becomes a question of how credible do you think this is going to last? And what we've been conditioned to know over the past, let's call it back to the Obama administration, when this got really weaponized in the way that we know it now, and sort of went back and forth. It always finds some kind of a resolution, if not at the 11th hour, then within a day or two.
Right.
And so the economic consequences never get a chance to really be seen. And so the Pavlovian response in markets, as you would expect, is, yeah, okay, government shutdown, blah, blah, blah.
But that's why I don't think do you think the discussion of a government shutdown is a real?
No, I don't think anybody cares.
Yeah, that's what I'm saying. I think interpreting pricing behavior as being related to the government shutdown, I think, is not correct.
Well, here's where I think it's always dangerous to say this time is different, but here is where this time might be different, because sometimes it is, right? Those are extreme examples, but extreme examples do occur, and when they occur in low volatility environments like this, because the spring has been coiled and the time has sprung, as it were, eventually. So does it have economic implications? Probably not. But could it be a sentiment marker? Yes. it could be a sentiment.
Maybe you're saying, but the implication being that it's a sentiment marker because it reveals a moment of a meaningfully different discounting of the competence of the American government. Like, where
in the
what
sense,
would sentiment shift on?
In the sense that, I mean, short answer, yes. But the reason that it would be a marker this time, maybe, and maybe it's not, we'll see. But the reason it could be a marker this time is because you're in this interesting situation where the markets are being told basically since the Fed meeting that they're not getting as much easing as they thought. And so the sort of cloak of invincibility that is cheap money is not going to be there to the extent that they want it. And the markets have, to their credit, been adjusting. It's why we have higher yields. It's why we have a stronger dollar. We've meaningfully unwound rate cut expectations for next year. In particular, for this year, things are semi-settled. There's only 2 meetings left. But for next year, that's been a live disconnect between the markets and the Fed. We still have a live disconnect. The markets are still at 60 basis points for next year. That's not what the Fed is thinking. The Fed is thinking only a single rate cut. But that's already a major shift in the sense that we were much further apart before that Fed meeting. We've had a significant adjustment in these expectations. So there is perhaps a level of sensitivity here that wasn't there before.
Normally, I would tend to agree, but the only thing that says otherwise is, I mean, just look at SPX straddle. SPX straddle for this Friday is a 1% move that it's pricing, and apparently, I just saw this today. Apparently, the average move that we've been getting around these non-farm payrolls is about 1.6% in either direction. So the fact that it's only 1%, just think about the election, right? Obviously, it was a deadline, an event. To your point, Dylan, like you said about hurricanes, I mean, it's true. I mean, if so-and-so, as soon as whatever hurricane hits the Gulf, everybody's paying attention to it. Where is it going to make landfall potentially? You get all the different patterns. You pull up the news stations. They're all talking about it. And then as soon as it takes 2 degrees to the right and it goes completely away from landfall, nobody even mentions the hurricane's name anymore. You can't even mention the last southern storm that happened, right? Tropical storm. In this situation, again, 1% move expected for Friday, and that's low compared to all 8 of the other non-farm payrolls that we've had this year. Mm-hmm. If there were really some government shutdown situation, we would see it in SPX options for Wednesday. Oh my God, the government's going to shut down. This could be an issue. I think the only way you have to even think about this potentially being an issue is if you compare it to the last time we had a government shutdown, 2018. And I just looked this up today. 35 days? I didn't even remember that being the case, but once I read it, I was like, oh yeah, that was the case. Like the government was shut down for 35 days. And again, you talk about deadlines and countdowns. I remember all of a sudden you start seeing all these different things. Oh, well, if this doesn't get paid by XYZ date, this is going to be an issue. And there's probably only a handful of stocks out of the 503 stocks that we pay attention to option wise. There's probably a handful that really would be affected by, well, they probably rely on the government for a large sum of their money, right? Like they don't be the only ones that I could think of that would affect that would be affected, and not the whole stock market. You know what I mean?
Let's just take a look at Palantir for a second when we mention companies' reliance on government contracts. Is it surging? No. Is it falling? No. It doesn't seem to care particularly about anything that's going on here. I mean, I guess you could say that for a sensitive name like this, you're maybe stuck in a range waiting for things to happen, but you're clearly not perturbed because what you've learned over the past, let's call it decade-ish, is that these things resolve themselves sooner rather than later. But again, like, it's not the actual thing that I think would be the scary thing. To Dylan's point, if this is anything, then it's some sort of a some sort of a marker of government dysfunction that ends up being a straw that breaks the camel's back, where at some point you just have so much dysfunction that you go, you know what? If the money was going to be really cheap, we could swallow this level of dysfunction because something goes wrong, money's cheap, you just lose some, borrow some more, go again. But if the money's not going to be as cheap, then the defense against dysfunction is diminished. And so you will accept less of it. Is this the dysfunction hill on which the market's going to die? I highly doubt it.
Yeah, I think that the tariff decision is a much bigger decision, actually.
Agreed.
Like, I don't think the government shutdown is relevant to the stock market's behavior in any way, shape, or form.
Yeah, I mean, if we take a look at
that said,
SR3,
though, hold on, but that said, before you leave Palantir, this is actually really interesting. Like, this is actually the example of a stock that could be affected. And I tell you, if this stock dropped $20, do you know how many people will be tripping over themselves to buy this thing at 150? A whole lot.
A whole lot.
And that would be great, except if it drops to 120, and then we have a real trade going on, guys. We have a real trade going on then, Palantir.
Yeah, I mean, there's a few of these names like this. I mean, I suppose you could say Tesla. There's a lot of government contracts there.
Is there? I mean, I guess so. Yeah.
I mean, as a kind of stand-in, right? You can't exactly put on a SpaceX options trade here, right? So if you're gonna look at sort of the Musk universe of government patronage, I guess this would be your vehicle. But again, there's not really anything going on here.
I like Jamal's point. I mean, I think that if Palantir sells off on perceived odds of a government shutdown, that would be a delightful opportunity for a lot of folks, I would imagine. But it just seems so unlikely. But I mean, if the stock's down, the stock's down.
Yeah, I guess Boeing, a lot of these government contractors, I forgot about that. Lockheed Martin, again, a handful of stocks.
Yeah, Lockheed is the other one.
There's some interesting trading opportunities potentially. These are the ones to keep your eyes out for.
Yeah, there may be something here.
Does Intel get smoked? Does MP, these names that have recently had these big investments from the entire government?
Probably not.
No, it doesn't matter.
Have you ever seen anything like this? I mean, outside of TARP, I might be derailing things here, but have you ever seen anything like that where, you know, you get the
not
MPs
outside of TARP,
the LAC, you know what I mean? It's incredible.
It's wild.
It's wild.
It's wild. I mean, but this is the kind of thing where if you're a student of history and you read about the South Sea bubble, you read about the railroads crash, you read about the .com crash, and you go, well, there's a lot of pattern making between these things.
Yeah.
And somehow toward the sunset days in sort of episodes like this, you start to see money chasing weirdness. And this looks a lot in a lot of spots here where money is chasing weirdness.
Never let a good crisis go to waste, right?
Well, you'd think. You look at Bitcoin here, sort of in the context of all of this. I mean, it's certainly up today. In a semi-spirited fashion, but it hasn't really gone anywhere since July. And so you'd think if we have all this buoyant risk sentiment, how come it isn't here? If this is sort of, I mean, because obviously this is not doing what gold and silver are doing. So any kind of idea that this is somehow digital gold is obviously nonsense. The price action is saying that's definitely not what's going on here. So if it isn't, then it looks more or less like risk sentiment by proxy. But it's certainly not as buoyant as, let's say, Nasdaq or even S&P either. Does this give you any kind of pause that the market is getting ready to be done being invulnerable? Because the sort of the highest beta of the betas in the risk sentiment space doesn't want to go?
Well, I think the crowded trades are, like you said, the Nasdaq, the gold and silver right now. I mean, there's no reason to jump into Bitcoin. Look, Bitcoin is the cool thing about Bitcoin. I'm not saying it's not cool anymore, but the cool thing about Bitcoin initially was the whole unregulated part, right? And the fact that there was so much volatility that it would move around 10 to 20%. I mean, it just pulled back, right? And in August 13th, whatever, 14th, I think is those tops there, pulled back from that. Normally, that pullback would have been 20%. 30%, right?
Yeah.
Now it's a 5% pullback because it's just matured.
And looks very regular. Looks like any other market.
I mean, that's the maturity of the product. That right there is the funds. This is what happens when you get ETFs and funds all of a sudden interested in something and they're tripping over themselves to trade it and do things with it. It calms down. The volatility of Bitcoin has calmed down. So I would say this is not unordinary. I don't expect it. I think right now it's just another asset class that people can do something with when it gets interesting, and it'll have its time in the sun again. I'm sure of it.
Right, but I mean, I think with
from a sentiment perspective, I get
sentiment indicators are detached from sentiment at the moment.
Whether so from a sentiment exactly. From a sentiment perspective, I totally get it. I mean, yes. Totally. The great irony of Bitcoin was everybody was screaming, including me, and will continue to be screaming, by the way, this is not money. And the reason that this is not money, among other things, is that it's a terrible store of value. It's incredibly concentrated and volatile. And until it's more liquid, it won't be more stable and it won't be closer to money. Well, with the introduction of these ETFs, we got the liquidity. It's become more stable, but it's had to, from a regulatory perspective, give up a bunch of what made it a pretender to money. Now it's just another risk-on instrument in the sort of universe of those. And yes, all of that liquidity has made it much more stable. It's matured. It's become much less of a crazy asset. But it's still, I would think, risk sentiment on creatine, as it were. And if that's what it is, how come stocks are surging and this isn't? If we are, in fact, in this sort of environment where a rising tide lifts all boats, I think to Dylan's point, why is the tide not lifting this boat? Is it something out?
But also, what if anything drives it in any way, shape, or form? And is there a trade any which way involved with it? I think there's sort of all those layers of questions. My sense with Bitcoin, and obviously I'm not a big believer, but is that Bitcoin tends to do whatever it does based on pure speculative sentiment,
right?
And then reverses its way into a story. So sometimes it's a store of value, sometimes it's a risk-on sentiment indicator, sometimes it's a bypass mechanism for fiat currency. It sort of reaches to the available story that justifies the price action more than the story actually drives the price action. So I think it's less relevant. I also think that gold doesn't actually move. Like gold was a much more reliable sentiment indicator, but I feel like gold has really started moving based on some version of speculative demand. Maybe gold is a play on the sort of Trumpian efforts to weaken the dollar. You know, maybe there's a dollar gold. Like if you're, in order for the dollar to go, if the dollar is going to rise, gold is going to goes to that sort of that Radigan trade we were talking about, which was long gold, long dollar, short gold, short Nasdaq. Obviously, the short Nasdaq piece is not working, but I wonder the degree to which gold, like Bitcoin, is actually a sentiment indicator, or it's only a sentiment indicator when it is convenient.
Right, and so this is sort of why I'm harping on this, because I look at this and I go, okay, well, if money just wants to go to assets, if it doesn't want to sit in cash, if there is a general kind of risk on vibe, shouldn't this be going higher?
I don't know.
Lower.
Yeah.
I mean, it went higher today for for what it's worth.
Dead cat bounce kind of, right? But I mean, there's really no story. And I think this kind of Dylan said, there's really no story right now with Bitcoin. And again, it'll have its day in the sun again, but gold and silver are way more fascinating for people to trip over themselves to keep trying to buy. The AI story isn't going anywhere. And so that part is you need the fear of DeepSeek or something else again to cause the Nasdaq to fall. I don't know how that's going to happen. But it'll come up, I'm sure, at some point or another. You know, the
Looking
gold and
at the
silver
mags here,
gold and silver are just much more interesting, and Bitcoin is just not. Maybe I don't know if that means you buy Bitcoin and you sit on and you wait for it to be interesting again, or you wait for another dip and jump in.
That's actually a really interesting perspective. If we say, you know what, nothing matters. What matters is the attention span of the speculative audience. And if the story isn't fun, then it's not going to go anywhere, and you're just waiting for the story to rotate back around. It's, in a sense, Dylan, a kind of endorsement of not thinking.
No, I mean,
something has gone sideways, you just buy it and wait.
Not thinking is the best founded investment thesis of the year.
Yes. Yes.
And I'm just wondering the degree to which even the sell-off, if you go look at the Mag 7 sell-off in this chart, you look at the Nasdaq chart, which basically is a mirror of the Mag 7 chart because of obvious reasons. I just wonder the degree to which you just have that one series, that one moment of pullback that is then, I would say the catalyst for that was not as many rate cuts as soon as we'd hoped. All the sort of notes from the September 17th Fed meeting.
It certainly seems that.
And then it's, the heck with it, supernova.
I mean, this is sort of, I think, where we're going to have
it's not going to be that bad.
And this, I think, is sort of the critical question, right? Because eventually, right, it's not like gravity stopped existing. Eventually, this market does turn, but eventually is not a trading thesis. You can't sit in something forever.
This is the 8 billionth example of buy the dip, though.
Well, maybe, right?
Until proven wrong at this point.
Until proven otherwise. That's right. That's right. Until proven otherwise. And I would say this top here, if you want to look at Nasdaq, is sort of the proving ground at the top. This is somewhere near the proving ground on the bottom, maybe even back down to the sort of this former high somewhere here. If you get under this, something different is occurring, just visually. And so we're kind of figuring it out. But from a risk-reward perspective, what makes more speculative sense? Not in a 10-year, the AI thing will eventually be what it is, because obviously, yes, agreed. But from a trading perspective, in a kind of 45 days in, a swing trade for a few weeks sort of mindset. In my mind, vol is really cheap, although it's not as cheap as it was last week, but it's really cheap. And it's better risk reward to be short than long. If you're looking at the indexes, again, opportunistically, not in a structural sense.
From on the index level, I really don't see. I mean, yeah, okay, fine. It makes more sense to be short than long, of course. I mean, who would want to really get long? Establish an initial position of long here. Nobody really, right? But
no, that's why if you're for, that's why I like Jamal. You don't know if I was yammering on last week. Short Nasdaq, short gold, long dollar. But short Nasdaq is the weakest of my suggestions at the moment.
Yeah, because the AI story is just so strong, right? But
I think it's crazy to be against it, even though I'm against it. But
yeah,
I know my overriding theme is the AI supernova. You know, basically paves any opposition gets paved over with thoughtless bullishness.
Wait, it's long Nasdaq, short Nasdaq,
short
long
Nasdaq,
dollar.
short gold, long dollar was my
gold.
after the Fed.
So
trade.
which one would you guys see having a 5% pullback first, gold or Nasdaq is the real question
Gold.
here, right? You just need
I
one.
would think gold.
Because I think the dollar is going to get stronger.
I would think gold too, right? I mean, yeah. I would think gold too, because I don't necessarily know if the Nasdaq has a 5% pullback coming anytime soon. I'm not sure.
I will say this: if you want to be completely ticker agnostic, just ignore which thing is which, ignore story, ignore narrative, AI, this, whatever.
Mm-hmm.
This gold chart looks stronger than the Nasdaq chart. Because this gold chart is making higher highs. It had its pullback, digestion, whatever that minor 3-day kerfuffle was last week. Shook me out, but nevertheless, we're making higher highs and with gusto here today. Whereas if you look at Nasdaq, we're not. We had a 3-day pullback. We've erased maybe about half of it. We couldn't make a concerted run at the high today. So is it falling off a cliff? Of course not. No, it's within spitting distance of a record high. But is it showing the kind of vigor that gold is? No. So from a purely ticker agnostic, just look at the candles in front of you kind of a thing, momentum seems stronger in gold, but also would I try to fight it? No.
Mm-hmm. No, that's a great exercise, honestly, just the ticker agnostic piece of it, because I mean, that enables people, like us who's charters, right? Like that can sort of look at this. Honestly, I could make a case for both of them, but truthfully, if it were agnostic, I'd probably want to be in this one more than the other one. But because the other one is peaking and it is gold, and gold has this ability to keep being a momentum play for longer than people expect, that's where the stories come in, right? Like that's where actually not being ticker agnostic works somehow, but it is a good
absolutely
exercise.
No, I do think thinking can be helpful sometimes.
I'm crazy enough that I can make a case for both.
At least in the reading of the ticker, it can be helpful.
Sure
sometimes.
I'm
in
crazy
very
enough.
narrow circumstances, apparently.
I'm crazy enough where I can make a case for doing both. I mean, but that's just how I like to roll at times.
I mean,
doing both what, Jamal?
gold
Getting
was
long
a great,
both.
silver.
Long
I think
Nasdaq.
Yeah,
silver was a phenomenal.
No, that's not what I
example.
want to do. I'm just saying from the charts. I'm just saying. From the charts.
And long dollar.
No, I'm just saying from
long
the charts.
dollar. I think
but
is one
long
of the most,
dollar. Yeah, I could. I'm into that actually. I have been doing that.
I think one of the scariest things might be that we're all on this program at this point, long dollars. That kind of consensus is a bit scary. But buying record highs, silver is a wonderful example of why you would. I mean, here was a consolidation. This broke out of that consolidation. I bought it here. And on we go. I mean, getting in the way of a trending market is probably not the greatest of all ideas.
We'll go to Jamal's point of forget trying to be clever. Own them. Don't bet against them.
Well, I mean, I think this is where,
which is obviously from a non-thinking standpoint.
This is where the momentum thing would come in.
Look,
right?
I got long, so I got long. I'm looking at this chart, and I can tell you the areas where I did. I got long in June, right, on the big pop. I'm sure people thought it was nuts then. But again, it's a momentum name. Yep, right there. It was the second time, the second one. I got long.
This guy right
those
here.
couple of in that one you showed in the first candle, and then the 2 days after.
That's a technician's dream right there.
In the first candle that you highlighted, and then those 2 days after it red, I was long already. I was like, damn, did I do the right thing? And then we had the next pop, boom, boom, boom.
Boom.
I got out. There. I got out maybe as it was going in, either the day before or the day after the next big move, like the 2 days after. You roll over? No, back over where we were, but like right there. I got out the day before that, and then I was like, damn, did I get out too early? No, I didn't. And then the next time I got long it was the other big pop, and I'm like, I want to be in as soon as it had. Not there, actually, the one after. I did that one. And I was like, I'm going to stay until 45, but I actually stayed until 43 and I'm out. And I'm out now. And that's kind of it. And, you know, whatever. I mean, I missed
was
the next
arguing
ride.
with so I missed all of the ones that you caught here, annoyingly, because I was paying attention elsewhere. But Vecchio finally put me on the spot and goes, "Listen, ticker agnostic. What do you do if it breaks this range?" I go, well, "You have to buy it. That's it." And then
hell yeah,
and then boom, there it is. I'm like, well, that's it. I've talked myself into it now, and there you go. So there's nothing inherently incorrect about buying something that's breaking out to a record high. If the trend is there, it's there. To Dylan's point on the dollar, this is one of the few things I suppose you could say is relatively cheap. So here's the euro. I mean, obviously, the dollar had a terrible start to the beginning of the year. And also, obviously, since the end of June, beginning of July, it has stopped falling. So if there was going to be something that's cheap, this looks like it.
I mean, I think long dollar is one of the best trades on the board. Honestly, I think it's going to be. I don't know when we start to see like some serious. I don't want to say momentum, but some serious sort of run in the dollar. I don't know when that's going to happen. I don't know how long it's going to take. Obviously things are a little different with currencies, as you guys know, but I think that's one of the best trades on the board, man. I really do. My current trade is in January because I know it damn sure ain't going to happen in October, November, December. Might not happen in January neither, but I think you just got to keep pushing it down the road and wait for it to happen. Because like you said, maybe a lot of us on this network are long dollar, but we all know there's been a lot of people who are still short the dollar.
Oh, the world is very short.
That tells you everything you need to know.
Yeah, the world is very short.
Here's a hypothetical for you, Ilya. Let's say the Supreme Court rules against the tariffs.
Yes.
What does that do to the dollar? If you knew the Supreme Court ruling, would you be long or short the dollar?
Long.
If the ruling was no tariffs.
Whatever the ruling is.
I think there ends up being a pullback, right? Like if they come out and say that, and that's going to be painful. But I think at some point or another, there will be the bounce that we're looking for. News is going to
like the dollar either way after the Supreme Court, Ilya.
Because I don't think that I think the biggest risk with the Supreme Court is that the Supreme Court throws the situation into some manner of disarray. That what's going to happen is the Supreme Court essentially says, okay, markets, you've had since April, so let's call it the better part of 5 months, 6 months now almost, to digest all of this. And you finally kind of anchored around the idea of what these tariffs are going to be and what levels they are and et cetera. And then you say, actually, everything you thought you knew, you don't know. And it's an open thing again. And obviously, if the court decides that way, we know who the president is. He's not going to take it lying down. He's not going to say, oh, well, the Supreme Court ruled. C'est la vie. That's not what this is, I would think. So now we're going to have a protracted fight. We're going to have all kinds of fire and fury around this. Somebody's going to get fired. That's not supposed to be. That's going to create another case somewhere.
But is that dollar positive? Is that
going to be yes, I think it's going to be a dollar positive.
How is that positive for the dollar?
Because I think what we learned in April, and part of the reason why the dollar has stopped falling, despite all this dovish talk, despite the Fed resuming rate cuts, I think the reason why the dollar ultimately stopped falling is because, and the reason markets came back in April, despite the tariff thing having not become meaningfully better. I think the reason we got that extreme and a turn is the president showed his hand in that he showed he is amenable to market discipline. And this was really it. So when you got this, and I'm sort of jumping to the long bond here because I think it illustrates well what we're talking about.
Capitulation.
Here's this pocket of crazy from, let's call it the beginning of April right into these lows.
It's
right
the reason
here,
that they don't talk about it in outside of America.
You've got stocks and bonds and the dollar going down at the same time here in crazy leaps.
Yeah, it's
because
asset
the market
due to wild
perceives
government.
Yeah.
Right. The market goes,
yeah, they were
"Wait a
like, hey,
second."
they went to and knocked on the door and they said, Mr. President, look, we love the tariffs. We love the tariffs. Don't we, guys? Yeah, we love the tariffs, yes. But the U.S. economy is crashing right now. We just wanted to let you know. That's what that was.
Yeah, they were like, so you know that thing where the world actually starts to think if we're good for the money that we've borrowed? This is it.
And where the value of
tell them that we're
everything
good for it.
from the currency to every equity, every asset of any kind just goes down.
Right. You can't, this was the moment when the essence of the financial system's structure was challenged.
But isn't that what makes the Supreme Court decision interesting?
Absolutely.
Yes, because I think what the markets learned is that ultimately the president doesn't want to take it that far. And in the aftermath of all of this, once we kind of got through benchmarking the rate cuts for this year, the dollar stopped falling and is once again the sort of cash of choice in a risk-off scenario. When people cash out, they'll be cashing out into dollars. And I think the dollar runs, if the Supreme Court creates chaos, the dollar doesn't run because the decision is good or bad for the dollar as such. It's because there's risk aversion and stocks freak out and money goes to cash. And the most liquid cash of choice is the dollar, and they're not going to perceive it as, oh no, the dollar, because they've already learned. In an environment where, oh no, the dollar becomes a story, the White House backs up.
You know what's annoying is that it's not possible to directly trade the Dixie. I don't understand why that's
you might as well just trade the euro.
I am. That's it. Identical. I just would like to be able to trade the Dixie, honestly. But yeah, you're right. I have a put spread on the euro. I turned it into a butterfly, but at some point I'm buying some of those wings back and just going to have a straight up put spread because that's the trade I really want.
What about the ETF, Celia, FXE?
You could. Those. You could. I think you're better off in the futures or frankly the spot market. You could have all of the size advantages of FXE. FXE, why would you want to have FXE? It's an ETF, so the sizing is more flexible than even the futures, and there's options. But if you didn't want to trade, let's say, the M6E contract directly, the micro future, which, I think is small enough to just buy and sell, no options. But if you wanted to have that kind of exposure, there's always spot. And we have this here on the platform. You could just go to euro dollar spot and do it that way. And there's, the flexibility in size here is incredible. You could go down to a 1K lot. So, and this is open 24 hours a day. It's not liquid 24 hours a day, obviously. There's periods where it's more liquid, there's periods where it's less, but this is probably the most liquid financial instrument in the known universe. Spot euro USD. It's the world's top most liquid currencies pitted against each other. What is more liquid? So FXE isn't that attractive unless you wanted to do, let's say, something like a call vertical, or if you wanted to, let's say, be a seller of puts. You could look at FXE from that perspective because obviously on SpotFX there's no options structure. Here on M6E there's no options structure. So if you wanted to necessarily do it through options, you could do FXE. I'm just doing it through the futures. I'm short M6E, and on the spot side, I'm short euro dollar itself.
I think the real answer is liquidity. I mean, it looks like a total of like 150 options total traded in FXC today.
Right. You'd have to really, really want to do it with options, and then for whatever. I mean, there's nothing wrong with saying, you know what, I just want to pay up for my risk, and if I'm wrong, it'll expire worthless, and I know up front what my outlay is. You could do that. If your thinking is, you know what, I've never engaged with currencies before, I want to do it through FXC because I can have a risk defined vertical and say, you know what, money out of pocket is there, it'll go or it won't. Fine.
I like 6E.
I don't have to manage it.
I like 6E for sure. I mean, and you just your Q is late July and August. Those moves downside, that September, just what was that last week? I think seeing those type of movements tells me, okay, the dollar actually has some serious bids. This thing could drop. That's what it tells me.
Yeah. I mean, you can see here where my entry is most recently on this. It's basically smack in the middle of this range. This is where I re-upped and pushed out to the Z5. I've been short this for longer, but obviously these things expire, which another fun fact about spot, it does not. It rolls over dynamically. But we're basically testing the underside of whatever this breakdown was, and we held here. So this is actually not an inopportune spot to look for a short. Even just looking at these candles here on the 4 hour, I mean, you have a clear kind of bottom of support right here. You backfill into it, and you just look at these candles, and you see these long wicks of exhaustion that attempt to get back up here and can't. And you go, well, this is what a short would look like if I wasn't already in one. And like right about here.
Does the government buying all these companies all of a sudden, you know, these companies that are happening, and you assume at some point more to come, does that have a positive influence on the dollar at some point? Is that essentially investing in America?
I don't think so. I mean, if you look at it structurally, my concern would be that it robs these companies of dynamism by essentially giving them the kind of backstop that makes companies lazy and less innovative. And the extent to which this is bad for U.S. economic growth, it means lower rates and less dollar yield appeal, ultimately. But that's a very long-term narrative.
I'm just trying to conceptualize some sneaky sort of positive catalyst for the dollar. You know, actually, besides the Supreme Court date, which is huge.
Ruling against the tariffs very good for the dollar?
Totally. Yeah. When is that, by the way? Or are they
late October?
We don't know.
Oh, okay.
At some point in October, the Supreme Court is supposed to let us all know.
I think if we had, I think that's actually one of the biggest catalysts, honestly, Dylan, like that you mentioned. It is something that,
and that's almost a binary, in my opinion. Although that's why I was fascinated, because Ilya was even suggesting that even if the Supreme Court holds up the tariffs, he still thinks a dollar benefit.
Yeah.
Yeah. No, you're right on. There's no binary. It is absolutely binary.
Yeah. I mean, I think it's more relevant in the sense that it is event risk that passes. And then the markets go, okay, we're clear of this. Now we can make a decision. Then necessarily the substance. But if the Supreme Court overrules what are these sort of national emergency tariffs, which is not all the tariffs, but this is the justification. IEPA is the law that all of this is justified on, and basically the president has latitude to declare what a national emergency in this sense is, and ostensibly the courts don't think he has quite as much latitude as he thought. And so if this gets overruled, most of the tariffs go away. But is he going to fight it? Of course. So does it create more uncertainty? I would think yes. Does that get markets to go, you know what, assets are at record levels. Maybe let's not have quite so much risk allocation when the dust just got kicked back up on this? Probably. That to me means cashing out. And cashing out is the dollar.
I wonder, are there other binaries like multinationals? Nike comes to mind. Other people that are obvious Apple sort of beneficiaries of a Supreme Court ruling against the tariffs that I just have similar binary characteristics.
I would think that
Nike's
one of
struggling in general, so it's harder because Nike's got corporate problems. But
yeah, I mean, I would think that one of the things that makes this really funky is you have to be able to, I think, go and say, okay, here's the Supreme Court ruling. It will stand. I can extrapolate this forward. But can you? I'm not sure. I'm not sure it becomes settled science.
On the flip side, some of those domestic American auto parts companies that are more pure play to the tariffs, that may be more binary in nature. Even if it's not a directional, but this might be an opportunity for a sort of old school tasty vol crush condor kind of situation going into this, with a November expiration.
Well, here's an interesting
30 to 45 days.
From that perspective, Dylan, here's XLE. So this is consumer discretionary. It's sitting right up against its former sort of swing high here back last year. It tried to break out and couldn't. It's kind of stuck here. IV rank is only 9. So if you wanted to take a bet, essentially saying if this is overruled, then maybe the consumers benefit because they get less of a tariff overlay and businesses can make that adjustment right away-ish. So maybe you get a little bit of a pop here. But if ultimately the Supreme Court says, you know what, the statute gives the president all kinds of leeway and we're just going to assume that the leeway's there, well, then maybe this ends up cracking lower. Either way, sort of having a kind of exposure here to basically say, okay, this thing has coiled up into some kind of a pop some which way is pretty cheap to take.
True that.
With that encouraging thought, overtime is out of time. Thank you, gentlemen, as ever. We'll be back with this show tomorrow, but don't go anywhere because in but mere moments, I'll be back for Macro Money to go over the big pitfalls that await us this week. Most importantly, of course, the U.S. jobs data. So don't go anywhere. We'll be right back.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
My most controversial market opinion is it's probably more political.
What's your most controversial market opinion right now?
My most controversial market opinion is that I shouldn't be following Mike and Nick. Just kidding. Love you guys so much.
The hottest take of this market? I gotta think about that. I don't know. I do like to trade the leverage, but that's not controversial. I don't know what controversy means these days. Like, I don't know. I'm sitting on cash. Like, I'm still sitting on a lot of cash, and I think that's generally seen as like frowned upon, but like I'm still doing it. I know market's been bouncing back up. I know things have been looking clear, but no, trust issues.
I honestly don't know if I have one. I'll say the fact that I like to trade earnings or direction as opposed to vol.
My most controversial market opinion is it's probably more political than it is anything else. So, I would say that, unlike others, I think the current political environment in this country is dangerous for the long term.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
And we are back to looking at these markets from a macro lens. And what do we find? Stasis. Quiet day to start the week, but plenty of event risk facing us in the coming days, culminating, of course, in the crescendo that is the monthly U.S. jobs report. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do here is take a look at what awaits us in the coming days. But first, take a look at what the price action showed us last week and see if we can't surmise what the stage setting might be as this week gets underway. So Here's how the markets fared last go round. Stocks a little bit lower, but not by much. S&P down 0.4%, Nasdaq down 0.6%. So not big moves, but certainly something that is sort of on the negative side, especially relative to what we saw in the prior week, in the immediate wake of the Fed monetary policy announcement, where the markets clearly had a more positive view of what is going on here. Last week, it seemed like the markets, on reflection, had a little bit of a different perspective. We can see yields higher, in particular at the front end, but across the curve, the 10-year up, the 2-year up. What's interesting here, of course, as well, is that while that occurred and the dollar went higher, euro down 0.4%, the yen an even more convincing 1.1%. Gold continued to surge, and as did silver, which we don't have here on the table, but we can get the sense from the precious metals just by looking at gold that they don't seem to really care about the story in rates. They don't seem to really care about the story in the dollar. The stronger dollar, the higher rates should be kryptonite for an anti-fiat, non-interest bearing instrument like gold, like silver, and yet they're continuing to power higher all the same. That might give us a sense of the moment here. In addition, of course, to the kind of slight fractionally risk-off vibe in stock markets, we get a little bit more convincing of a view in Bitcoin to the extent that it is kind of risk sentiment on steroids. There you get that decline of 4.8%. So kind of a soggy thing in the way that the markets performed last week. And when we look at the way we start this week, we get a bounce in Bitcoin, though, of course, it doesn't really take us out of the near-term range. There's a little bit of a correction in the dollar. It pulls back a little bit. The euro up a tad today, as is the yen, although, of course, given last week's moves, these amount to a correction rather than anything that overtakes what we saw last week. Yields tellingly come in a little bit, the 10-year down, the 2-year down, so bonds are a little bit higher. Stocks ultimately try for the upside, but don't really get very far. S&P closes up just 0.16%. That's, of course, a pittance, especially when we consider that at one point today it was up 0.6%. So this was a much more meaningful move earlier in the day. Similar story for the Nasdaq. At one point, looking at this a bit earlier, sort of from the open to the high, the Nasdaq was up over 1%. Looking at it now, of course, we get a close of just a little over 0.3%. So momentum is certainly a little bit weaker. The standout today, of course, the nearly 4% jump in crude oil. But if we take a look at this sort of in the context of where things have been, this is not an especially convincing sort of move. This looks more like something that is still, give or take, within the confines of the range that we've been looking at for the most part. I mean, if we look at, in particular, the Z5 contract, we don't really have a meaningful departure from the range. We certainly have a potent gap. We certainly have a strong start to the week, but on the whole, the story seems relatively mired still, with a bottom around 60, 61 and a top around 65. Now, with all of this in mind, we of course see that, again, crude oil aside, because it seems to be on a mission all by itself, the general sort of vibe last week and going into this week seems to have mainly come from this adjustment in Fed policy expectations. And in particular, we can see for next year. So, of course, we had a rate cut here. So whatever the tally was before that rate cut, 140 basis points, you would expect it to come in some because this cut has now occurred, but it's come in more than you would expect. So 140 minus a 25 basis point cut would give you 115 basis points. Now that we're here at 92, there's about a 23 basis point gap. That is to say, the markets have shaken out 23 basis points out of the outlook beyond just adjusting for the cut that's already occurred. So the outlook for next year in particular has narrowed at 59 basis points, as a matter of fact. This is the least dovish that we've seen the outlook for 2026 since about, give or take, June. So mid-June or so. So we're talking a little bit over 6 months. And the view for this year has been pretty well steady since before the Fed policy announcement and through it. So from basically the beginning of September, the outlook for this year has looked about as it does here. And so with that, you end up with 2 rate cuts now. Of course, the Fed has said that they're out to 3, but even the markets don't really see that as credible. And of course, we've talked a lot about how the addition of Stephen Miran on the board has kind of skewed the Fed's averages for their forecasting. We can see right here, from a base of 4.4 this year, as of September, the Fed now envisions 3 cuts narrowly. It was holding on to only 2, but only by a very, very small margin. And when we look now at what's going on for October, we can see that in October, we're at this point fully baked in for another cut, 89%. But when we look at December, it's not nearly quite so convincing. We're at about a 70-ish% chance that we're going to get this cut. It's about 70-30. But if we compare it to what this looked like even a week ago, it was more like 75 and some change. Now, it is a little bit higher than last week. Last week, we got as low as 65%. So we're sort of on the fence, but it seems clear that the markets have made a sort of adjustment in a less dovish direction, ostensibly inspired by this revision to Fed forecasts, where growth expectations were increased, unemployment rate expectations were decreased, narrowly higher inflation was marked here for next year than it was back in the June forecast, from 2.4 to 2.6 on both the headline and the core. And so the market's looking at this and saying, well, the Fed is just not looking to do that many rate cuts. They're still baking in a lot more than the Fed itself, obviously. We can see here the Fed's only got 1 rate cut for next year. The market's at 60 basis points, still see at least 2 with a strong optionality for a third. But clearly they've backed off some. And we start to see those consequences. So the S&P, we can see on reflection, has kind of stalled, to give you a sense that sentiment is anchoring here as the markets start to think about maybe there's going to be less easing than they wanted or hoped for. And the dollar has attempted to carve out something like a bottom and is trying to edge higher as things get less dovish on the policy front. Now, that's our stage setting. We open this week with a bit of economic data outside of the U.S., and we start in the sort of Asia-Pacific space. We move to Europe, and then the big event risk out of the U.S. hits. So we begin with China and these PMI figures. This will give us a sense for how the world's second largest economy is doing economically. It's been mired in a deflationary slump for 9 consecutive quarters at this point. And we can see that the expectation for these PMI numbers is that we're going to basically remain stuck near neutral. So as ever, PMI numbers are centered around 50. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what we see here is that really since the beginning of this year, these official figures out of China have been hugging neutral. They've really gone nowhere fast. And it's largely because the economy is in this kind of anemic state where you can't really find any meaningful growth to speak of. And looking then, relatively speaking, to what this looks like in terms of global growth, we once again find ourselves in this sort of environment where the U.S. is the only game in town because Europe is this kind of anemic and for its own reasons, and China is expected to remain so. And so the only kind of meaningful growth that we really find anywhere on the board at this point seems to be in the U.S., giving us a single point of failure. Now, the Fed is obviously starting to cut rates because it's worried about sogginess in the labor market, perhaps giving us a point of failure, but certainly no evidence that this is any kind of an imminent danger at the moment. So for now, it looks like we're going to continue to precariously balance on the shoulders of U.S. growth, at least until there is some sort of give there. But if there was any hope that with that give would come some sort of a backstop from China, it doesn't look like we're going to see that this go around. Then we're going to get a rate decision from the Reserve Bank of Australia. They're expected to remain on hold here at 3.6% after a cut last time for the target bank rate. If we look at what the futures are pricing in here, that's the yellow line right there, we can see that's hovering around 3.3. In other words, here we are at 3.6. We're at 3.3 for the year-end expectation in the futures. So there's one more cut in this wedge here that's on the table. And so what the RBA is going to be interesting for this go-around will be a sort of barometer on global growth. They're relatively early in the supply chain in Australia, the global supply chain. And so what the central bank says about where we head from here and whether there's any more or less easing on the board and whether this forecast broadly remains, that's going to be what's interesting for markets. Then we're going to get inflation data out of the Eurozone. The expectation is that we're going to get a rise up to 2.3% on CPI. Now, that would be a meaningful increase. We can see here with the naked eye that this would be the highest in a while. Indeed, it would be a 7-month high. The last time that we were at 2.3% was February of this year. What's interesting is that when you look at the breakdown of inflation, you see that most of it seems to be in areas that the ECB doesn't have much agency over. So you have a lot of it in food, in fact, the majority of it in food. One would think that this kind of stickiness in restaurants and hotels is in large part overlapping with whatever's going on in food. There's also this kind of lingering issue with the cost of insurance that's moving around the miscellaneous component. But the main issue clearly is an almost full 1 percentage point of inflation being contributed from food and adjacent costs. And so this doesn't seem like the kind of setup where the ECB would look and say, well, inflation is obviously getting stickier. It's obviously doing something we don't like. Maybe we should think about raising rates. That is not the likely outcome. Of course, the markets don't see it as such. Looking at what we have that's baked in for ECB policy at this point, no more rate changes for this year, no rate changes for next year. In other words, whatever the euro might have found in terms of policy support out of an inflation number going higher here probably isn't there. And that, of course, might be interesting in the sense that the dollar has attempted to bottom against the euro and is kind of begrudgingly forcing its way higher since bottoming in early July. And that's despite the fact that the Fed has resumed cutting rates and there is no scope for it seemingly in Europe to push in a dovish direction. So the euro here under fire despite what might look like an adversarial setup for the dollar, where the Fed is getting more dovish, the ECB probably isn't, and yet the euro is starting to take incoming. So if anything, this data might be significant in the sense that it allows that dynamic a touch point whereby it might be a little bit soggier going into the data. It might get the clearance to resume after the data. And so the data might be more relevant in terms of its passage rather than its substance. And then, of course, we get into the U.S. economic data flow. First and foremost, the ISM PMI report. The expectation here is that we're going to be relatively steady on the service sector front. This works just like any other PMI, centered around 50, as we were saying before. So at 52 for a second consecutive month, the service sector is not running away, but also not falling apart. The situation in manufacturing expected to give us another contraction at 49.2, but the pace seen slowing a little bit. But looking at this on the whole, of course, more of the economy is services than is manufacturing, so skewing in that direction. We're probably somewhere at a kind of weighted composite ISM level of plus or minus 50 on the dot. And so the U.S. economy on this measure is basically standing still. The story from the analog PMI data from S&P Global is a little bit rosier, but it's also a little bit more volatile. So we had this very, very potent melt up in growth rates in the second half of last year. Then, of course, around the tariffs, this fell off as those tariffs were being rolled out. This was, in fact, a big part of how you ended up with the sell-off that you had in stock markets at the beginning of the year. That, of course, is this right here. Policy expectations getting more dovish, the S&P coming off. That was, in large part, this swoon in sentiment. Since then, it's come back, give or take, to where it started. But we can see the most recent readings here for the past 3 months or so ticking marginally lower. Now, this is where things get interesting because, of course, there is still this disconnect And if it does look like the U.S. economy is starting to get a little soggier, well, then the markets will look like their expectations in their excess dovishness make more sense. But if not, then it's going to look like perhaps there's more of an adjustment to be made here, which might be more sogginess ahead for stocks, might also be more strength up ahead for the dollar, sort of along the lines of what we've seen already, where if this continues to correct higher, this might get pulled lower, this might get pulled higher. Now, finishing out the week, of course, the all-important U.S. jobs report. The expectation here is that we're not going to get anything earth-shattering. 39,000 jobs added. The unemployment rate holding unchanged at 4.3%. Of course, the Fed made its rate cut contingent on signs of weakening or cooling, as it were, in the labor market. So ostensibly, the markets want this to be a relatively cool number because it would encourage the idea that the Fed will continue to move on easing. It would also suggest that the Fed has a good grasp on the economy and is generally doing the thing that it's supposed to be doing. If this surprise is higher, then I think perhaps the markets get a little bit unnerved, even though that's maybe good for the business cycle episodically. I think it would suggest that the easing that the markets want isn't necessarily coming in the degree to which they want it. And of course, we've seen already over the past week and some change, that's not a happy thought for risk sentiment. For what it's worth, looking at the U.S. Economic Surprise Index, it is well north of zero. And so we can see that the overall U.S. data flow here has tended to be generally surprising on the upside. And so the risk here perhaps is that this jobs data does indeed dilute these rate cut expectations and hurt sentiment in so doing. So looking at my exposure here, it hasn't changed since last week. I'm still long the dollar here against the Aussie, against the pound, against the euro, against the Canadian dollar. I am likewise here still holding this longer-term exposure in Brazil. This is until the end of next year. EWZ is the Brazilian market ETF. I've put on a little bit of a short position in stock indexes, essentially looking for this kind of sogginess that started to emerge last week to carry forward. We'll see if the risk reward here, which is how this thing ended up getting put on, ends up getting borne out. I'm still long silver, which continues to power higher, and liking more this tactical long shot I took on the bonds. They looked like they'd pulled back enough, and there was maybe a reaction bounce. We saw some of that here today with the rise of 0.8%. So still holding that. We'll see how it goes from here. And that is Macro Money for today. As ever, we are here Monday through Thursday right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Welcome back to the Tasty Crypto Show. I'm Dan Cecilia, and today I'm joined by Young Chu, CEO of Stablecoin X, the first publicly traded treasury company established to focus on the Athena stablecoin ecosystem. Young is a CFA charter holder and brings over a decade of experience in leading both traditional finance and crypto companies. Young, welcome to the show.
Yeah, thanks for having me, Ryan. Thanks for having me, Dan.
Yeah, for sure. Let's just jump into it because I think this is a really interesting topic. Stablecoins have been hot in the news, and we've integrated them on our platform. So, what drove the decision to create a treasury company specifically for the Athena ecosystem? Why is this model more appealing to investors over a direct investment approach?
Yeah, so I started this journey. I've been in crypto now for about 8 years. Before that, I was in traditional finance for over 12 years. Started my career at Citigroup. But as I was talking to you before, in the past, I was previously CFO of Hedera Hashgraph. Before that, I was chief investment officer at Abra. But it's just wild. It's just wild how much we've progressed over the past 8 years in this space. And so recently, just about last year, a friend of mine asked me to join as CEO of TLGY Acquisition Corp, SPAC. He's also been in traditional markets in the past. He's been in SPAC world for about over 18 years. And he brought me on board to head up TLGY to look at what we can do in the crypto company with the new administration. And so we were talking late last year, and we saw what Michael Saylor was doing with strategy, obviously, what Soul Strategy, what Leah Wald was doing with Soul Strategies. And we thought we could improve on that model, right? So what those guys are doing is basically buying crypto at spot, putting it into a company, and essentially, just having that listed vehicle ride on the beta of those of Bitcoin or Solana. But coming from the layer one protocol at Hedera previously, I thought we could improve on that because a lot of these projects are looking for two things, right? I mean, they're looking for a public market advocate to help them get the word out about their protocol beyond just the crypto community. And so that's one thing that I think a lot of foundations in the crypto space are looking for. And the other thing is for investors, they're looking for a decent return, right? So being, again, historically at Hedera, we sold tokens at a discount, anywhere from 30 or 50%, OTC, and they're locked tokens. And we sold them to investors, hedge fund managers, VCs. And we thought we could create some value to investors by being able to create a digital asset treasury company, buy these tokens at a 30 or 40 or 50% discount, and then have those investors or shareholders benefit from that discount that we're purchasing these tokens at. So that's how we came up with the idea. That started late last year. We've been talking with several foundations in the space. And when we came across Athena, we thought this would be a fantastic partner to work with. Just the fact that they are in the stablecoin space. We know that Circle is coming up with their IPO in the next several months. This is early this year. And so we saw their S1 filing. And the stablecoin narrative is a pretty simple, yet very compelling narrative to give to Wall Street and Main Street. So that's how we came to where we are. We signed an LOI with the Athena Foundation back in April, and we got the definitive merger agreement with them back in July 21st.
Awesome. Yeah. And I think it's a really interesting insight. It's an awesome story, by the way, just kind of the background and how this came to fruition. And, if you're a crypto native like I am, like you are, even you're following the space, obviously Athena was kind of a big name in the stablecoin space over the last couple of years. So it's getting more traction now. Obviously, stablecoins, to your point, have been, accepted widely with this new administration. And, I'm curious, I read in the press release and doing my research, you guys raised close to $890 million in financing to go out and purchase the token ENA, which is the protocol token, USDE being the stable coin. This is a huge bet, obviously, and makes you the largest holder of ENA. So can you just walk through that ENA investment thesis for us?
Yeah. So, like I mentioned, it's there's a great shift happening in the stablecoin market, and we call this a stablecoin super cycle, right? The Treasury Secretary Scott Bessent, he expects stablecoins to grow from, I believe right now it's just under 300 billion, right? Because there's been a massive rise in USDE over the past month or two. So now we're close to about 300 billion. And Treasury Secretary Scott Bessent expects stablecoins to grow to about 3.7 trillion by 2030. So that's a 12x increase in just the total addressable market in the next 5 years. On top of that, the yield-bearing stablecoins, they're currently about 5% of that 300 billion. And there's been research reports out there from JP Morgan that estimate in a bull case that the yield-bearing stablecoin market could grow to about 50% of the stablecoin market in the next 5 years. So you're seeing, not only you're seeing a 12x increase in the TAM of stablecoins, you're potentially seeing a 10x increase within the stablecoin market of yield-bearing stablecoins growing to be half of that $3.7 trillion market. So that's a massive compounding effect. And we think that is by the definition of what the stablecoin super cycle is. And ENA and the Athena protocol is well poised to benefit from that.
Yeah, no, it's a great point, and I think any investor, right, when they look at this asset class or they look at stable coins and they think, I want to yield, right? That's kind of what investors are looking for. And Circle, USDC, some of these traditional issuer stable coins, USDT, they don't pass that yield on. So I think that's where, if you do the research into Athena, that's where kind of it stands out. So, it's a great point and definitely something that, sets it apart. So for our audience they're typically familiar with traditional derivatives, options, futures, can you explain where that yield comes from? Can you kind of dig into that a little bit, that delta neutral approach?
Yeah, so this is a pretty common strategy that's run by a lot of hedge funds in the crypto space. It actually came from the traditional finance guys. They've actually done this with US Treasuries. And so what they do is they typically sell the futures and buy spot. And that's in TradFi. But in the crypto world, what a lot of these hedge funds have done in the past, and because there's a pretty nice premium with it, they sell Bitcoin futures and then they buy the spot Bitcoin. So they're hedged, right?
Right.
So whatever happens to the price of Bitcoin, it's always delta neutral because it's hedged. You're buying spot, but you're selling futures. And there's a premium to futures because typically people pay for that premium because they're getting leverage on those Bitcoin futures. So that's what the Athena protocol does. They sell the Bitcoin futures and then they buy the spot. And then they pass on that difference, that premium that you're earning, that you're gaining from that selling the Bitcoin futures. They pass it on to the USDE holders. And so that's what's called the delta neutral hedged position. And this is very common with a lot of the larger hedge funds in the crypto space. And this has been proven in the TradFi with US Treasuries, like I mentioned before. And so that's where the yield comes from.
Gotcha. Okay, so it's kind of like a carry trade in other words, exactly. And so digging that a little bit, and I think investors, a lot of them want to know how to value things, especially in crypto, right? Sometimes it's vague, especially if you're coming from TradFi. Maybe they want to value it on fundamentals, but there's not often one-to-one fundamentals with TradFi. So with this ENA, Stablecoin X. In ENA, what would you say you would value that on for investors? Like, is it token price? Should they look at protocol revenue? Obviously, the carry trade's a big component. Or is it just a broader bet, to your point, on stablecoin innovation and adoption?
Yeah, so for valuing Stablecoin X, I mean, you got to think about it like in two different ways, right? There's the beta component, right? Basically, because we are a big treasury company of the ENA tokens. But then also there is the alpha, right? And so that alpha will determine at what sort of premium to MNAV we trade at. The NAV is going to be based on entirely by the price of ENA tokens. So that's what I call the beta component, right? And so the ENA token price is driven by a lot of things. It's driven by the growth of the USDE. It's driven by the USD users of the Athena protocol, the protocol revenue itself, and increased distributions of USD on more wallets like exchanges. Like they had a recent announcement with Binance where they're basically partnering with them to quote a lot of the cryptocurrencies in USDE. So there's all that. And that to me is what determines the MNAV. And that is the biggest component of the Stablecoin X price. And that's the beta, right? But then the second component, like I mentioned, is the alpha. The alpha is really how good of a job that we do, the Stablecoin X management, in terms of getting more ENA tokens per share for our shareholders. And so that's things like we intend to stake our ENA tokens onto the validator network, on the Converge network when it launches. We're also looking at different ways where we can potentially earn yield by maybe even buying USDE and taking out debt so that we can, well, the debt's got to be at a lower cost than the yield we can earn on USDE. But there's things like that we're thinking about. And then also we have a collaboration agreement with the Athena Foundation. It's a 5-year collaboration agreement where we have a right of participation to participate in their future discounted token offerings that they provide to the OTC market. So we can purchase, ENA tokens. We purchase tokens at a 30% discount in our previous pipes. But going forward, we have a 5-year right of participation, continue that, buy more ENA tokens at a discount, and then that's one way we can accrete value to our shareholders. As long as we're buying these ENA tokens at a healthy discount versus then the shares that we can issue at. If we're issuing shares at a 1 times MNAV or 1.1 times MNAV, and we're buying these tokens at like a 30 or 40% discount, we're accreting value to our shareholders that way. So that's how, those are 3 different ways we can earn alpha on the ENA token so that we can trade at a premium to our MNAV.
Yeah, no, that makes a ton of sense. I appreciate the illustration and you simplified it a ton. And I'm actually interested, you're going to go out, and it sounds like you'll go out and actually try and run some DeFi strategies. So would you, to try and earn a little bit more of the yield, would you be using like Aave, or would you be going out like Pendle is another one I think is interesting, or is that kind of something you're still figuring out?
We're still figuring that out, and we have to be careful because we are going to be a listed company.
Sure.
And so some of these protocols that you mentioned don't necessarily run the right KYCs.
Gotcha.
And so we have to be careful on which particular platforms we decide to run these strategies on. But yeah, I mean, we're exploring all those different things, but we have to be mindful that we are an SEC reporting company.
Of course, yeah, for sure. So, I think when I hear yield-bearing stablecoin, I think other crypto natives, when they hear yield-bearing stablecoin and carry trade and some of that, we look at maybe, you think of like Terra Luna, you think of some of these other blowups from last cycle. So a lot of critics will point to like the funding rate risks of the perps markets, futures markets, exchange counterparty risk. Obviously, you pointed to, the protocol is not running KYC, regulatory oversight risks there. So how are you addressing these risks and mitigating them at being, the largest CNA holder?
Yeah, so I mean, we've come a long way since the Terra Luna debacle, and that was an algorithmic stablecoin. This is a synthetic collateralized stablecoin with the future spaces trade as its collateral, like I mentioned. But there's the ways that we mitigate risk is there's a lot of different things that the Athena protocol can do itself, right? And then there's the things that Stablecoin X does as a participant or as one of the larger holders of Athena tokens. But just to kind of broadly talk about those different topics that you mentioned. So the funding rate is one of the risks. It's historically been mostly positive. It's ranged anywhere from 5 to 25% over the past 3 years. But the funding rates do from time to time go negative. And the Athena protocol does have a reserve to buffer losses when rates do go negative, right? It usually happens, I think in the past, it's happened about to 10 or 15% of the time, right? So they also can close a future spaces trade and purchase USDTB to fund those, yields to USDE holders as they wait for the, funding rates to go from negative to positive. By the way, the longest that the funding rate stayed negative is about hasn't been longer than 13 or 14 days.
Oh, wow. Okay. Yeah.
So I mean, but this is something that the Athena protocol does itself to manage those risks. But we, as largest holder of the Athena tokens, we participate in the governance, right? The governance of the Athena protocol. And so we don't manage directly those types of decisions. We can basically, participate in any sorts of decisions or any sort of votes that come up where we can either, appoint or maybe, give suggestions or change some of the risk committees within the Athena protocol, but we don't directly manage that ourselves, right? Gotcha. So that's, as a large Athena holder, token holder, that's how we can mitigate some of the risks. Then there's also questions about the counterparty risks, right? Because the Athena protocol is running these future spaces trades on various exchanges. Well, the exchange that they run, the biggest exchange that they run on is on Deribit. And Deribit now, as you know, is they're owned by Coinbase or merging with them, and they're going to be a $80 or $90 billion market cap company when they close a merger. I think they already closed actually, so they are the counterparty risk there is pretty mitigated in my opinion. So there's various different things that are happening, but we've come a long way since those Terra Luna days, and in fact, when the funding rates do go negative, when you close those positions, there is this kind of mean reversion, right? Back up to, that's why the funding rate hasn't been negative for more than 1 or 2 weeks. So that mean reversion does allow the protocol to get back into a positive funding rate environment.
Gotcha. Yeah. And like we were talking about before the show, like we've come a long way since we both entered the space, and, liquidity, we've seen more liquidity come to the space. Obviously, with the positive regulatory environment currently in some of the, regulations passed here in the States, it makes it a more trusted environment to operate. And then Coinbase, some of these counterparties you talked about, they're well capitalized, right? So that as a participant, that makes me feel pretty good, and obviously come a long way since last cycle. So I want to get into this stablecoin super cycle narrative and dig into this a little bit, because here at Tasty Trade, we're traditional finance first. We provide access to derivatives, futures options, Forex. And stablecoins was one of the big things that we've implemented and seen a huge boost with not only current clients but new clients funding. So I want to know your opinion on what's driving demand for stablecoin adoption, and then how Athena kind of fits into this.
Yeah, so as we've seen, there's a lot of institutions that have been kind of waiting on the sidelines. Banks in particular, we're kind of joking about this, like if you're old enough to be in this industry like 5 or 10 years ago, you probably had your bank account shut down a couple of times, right? Yeah. But now banks have been waiting for regulatory clarity. They have it now with the Genius Act, and banks and institutions are, just starting to dip in, right? That's why we've seen just in the past 2 months, man. I mean, like the stablecoin market cap grew from 250 billion to 300 billion, 50 billion in just a couple of months, and you're seeing more and more institutional adoption. So that's what's really driving a lot of the growth in the stablecoin super cycle. And we've seen, the Genius Act was passed, this is my opinion, because the stablecoin industry participants are now the 12th largest U.S. Treasury holders in the world. And when you have a lot of these sovereigns that are a little uncertain about holding U.S. Treasuries, or a little uncertain about the geopolitics with the Trump administration and the tariffs and all that, China, I think they're not a net seller, but they're not renewing. They're not buying any more U.S. Treasury. They're not buying as much to redeem or to replenish. So a lot of these countries are starting to dip down in terms of their U.S. Treasury holdings. And you see this little industry participant called stablecoins and Tether and Circle and some others that are now going through up in the ranks of U.S. Treasury holders. And so, in my opinion, that's why I think the Genius Act was a priority for Washington. And with that, you're seeing a lot, now that you have that clarity, a lot of the companies, a lot of banks, a lot of sovereigns are paying attention to stablecoins. And so I don't think that's going to slow down anytime soon. It's going to continue. You're going to have other countries doing the same thing, passing something similar to the Genius Act, and you're going to see a lot of adoption here.
Yeah, no, it's a great point. And, obviously if you're in the finance industry and, you follow some financial media, there's always this talk about, government debt and, I guess, some of these sovereigns are reducing exposure. And then, if you're in crypto, you're realizing, oh, wow, these issuers, these stablecoin issuers, they are the buyers, and they're the big buyers. And nobody, if you're outside of the space, nobody's really paying attention until obviously this year to these issuers. So yeah, the regulations had to catch up, the laws had to catch up. So, I think it fits with that stablecoin super cycle narrative. And, you mentioned Circle. Circle was a massive IPO. I saw it here at Tasty when it went live, on the trade desk, some of that stuff, kind of how it traded, beginning during its IPO, and obviously Tether, right? And Tether just launched Plasma. It's the biggest stablecoin, US dollar Tether being. And so I'm wondering, how do you view competition from those players? Obviously Athena is a little bit different, but there's those incumbents and then the new entrants. So how do you view that competition?
Yeah, so they, like you mentioned, they are different. USDC and USDT, they don't offer yield to their holders. They keep it all themselves, right? So we don't necessarily view them as competition. In fact, Tether, they're very complementary to Athena, right? So USDT, they comprise about like 15 to 16% of the collateral, or we have, the Athena protocol has a redemption liquidity pool so that they can stay liquid and they can have people that are redeeming, they can pull their points or their cash out through USDT. So they're very complementary in that regard. So we don't really view them as competition. But there are new entrants. We encourage that. There's more innovation to come. We're just scratching the surface, right? And so even though Athena is the largest yield-bearing stablecoin with roughly about 4 or 5% of all the entire stablecoin market, there's definitely a lot of room for new entrants to come in. And so we haven't seen any other compelling other protocols, but I'm sure there's going to be some. I'm sure there's going to be others. And we have many years to runway until we get to $3.6 trillion market, market cap in stablecoins, 50%. I mean, there's so much room for other participants to come in. So we welcome that.
Yeah, no, I think rising tide lifts all boats in this space in some respects. And obviously, you want to keep the bad actors out. And so obviously encouraging and working with each other, like you said, Tether makes up a portion of Athena. It's good. It's positive for the space. I've been in the space since 2017. I know you've been in longer, and just seeing people, seeing the way it's developed and seeing how these protocols kind of work together, we should welcome some of these new entrants, some of this competition, and hopefully it'll grow the space even bigger. So I guess if we look ahead, right, and you talked about, you guys are well capitalized, you have a long runway, multi-year outlook, what would need to happen in the Athena ecosystem for Stablecoin X and, what you're doing here to be considered a major win?
Yeah, so I mean, like I mentioned, the past two things, it's the ENA token price performance. If that is our biggest driver of our stock, because that is what our MNAV is benchmarked against, right? So if the ENA token performs well, we do well as Stablecoin X. So that's one, and those things are driven, like I mentioned before, like growth in the USDE, user growth in the protocol revenue increasing, distributions of USDE, all that stuff is what we would love to see. And the other thing that we would love to see and would consider a win is if we increase our ENA tokens per share. That is how we get that extra bit of juice to go from just a MNAV benchmarking the ENA token price, but if we trade at a slight premium because we're able to grow the ENA token per share, that would be also another huge win.
Gotcha. Okay, so we have to look at MNAV, have to look at ENA price. Like we mentioned previously, that's kind of what we're benchmarking and what we'd like to see, what you'd like to see over the next couple of years. So, being in crypto for so long, you always get kind of the skeptics, right? Or you get, why should I buy this? Or it's, all the stories, all the critics. So what is your message to traditional investors who might be hesitant about this approach to stablecoins and crypto exposure?
Yeah, so I mean, for TradFi investors, which is the market that we're targeting, right? Primarily on top of all other crypto investors, if you want exposure to explosive growth, right, expected in the stablecoin market, there's only really a couple investments you can really make, right? So there's Circle, right? There's Circle stock, which is now trading at, I think, about 130 PE or something like that. I mean, they had a phenomenal ride. They went up to about $50 billion market cap, and now I think they kind of settled somewhere around 30 billion. But they're still, I mean, this is not investment advice, but if you ask me, it might be a little rich at 130 times PE. And so there's you can invest in that, or you can buy Stablecoin X stock. Stablecoin X stock, we haven't gone effective yet. We expect to sometime in the next several months. But when we do become effective, there's going to be now potentially two different types of vehicles or investments that you can deploy your stablecoin investment thesis into. And so we think that is going to be an interesting dynamic between, we think some of these things will probably trade at close to MNAV or maybe slightly above, but this is where investors that are in traditional finance, if they want to express that stablecoin narrative, that's thematic, there's really only a couple investments that they can make. It's Circle, the Stablecoin X, potentially in the next couple months.
Gotcha. Yeah, we'll definitely have to look at that, and I'll be following it closely as you guys progress to get listed. So we got a minute left. I just want to allow, where can our audience find you and follow along after today's show?
Yeah, so we're on X. The Twitter handle there is @stablecoin_X. We post there pretty regularly, so there's a lot of posts that we make about what's happening with the Athena protocol. We give them updates on what's happening with us particularly. So you can follow us on X. That's the best way to follow us, sir.
Awesome. Yeah. So Young, I appreciate it. This was a great conversation. Would love to have you come on again. Maybe as you get closer to listing, always down to chat. Love hearing about this. It's really interesting, and I wish you luck. And I'll definitely follow along. As you guys get closer to listing.
Thanks, Dan. Thanks for having me.
All right, that's it. We'll see you guys Wednesday. I'm Dan. Peace.